This is a very belated video about the 3 bank failures that took place in the States in March 2023. And also I'll talk about one that nearly went under. I'll provide you with some facts and a little commentary along the way. The first bank to fail was Silvergate Bank. This was on the 8th of March. Then only 48 hours later, on the 10th of March, Silicon Valley Bank failed. And again, only 48 hours later, on the 12th of March, Signature Bank. It was closed by regulators citing systemic risks. All 3 basically went under. The collapse of Silvergate Bank and Silicon Valley Bank were the second and third biggest bank failures in US history. California-based Silvergate Bank was heavily involved in the crypto space. According to Wikipedia, open quotes, by the fourth quarter of 2022, 90% of bank deposits had become cryptocurrency-related, close quotes. Silvergate had been badly affected by the failure of FTX last year. Silicon Valley Bank, also based in California, provided venture capital for tech startups. New York-based Signature Bank had originally been more involved in real estate, but then moved over into the world of cryptos. Quoting from Wikipedia again, open quotes, by early 2023, Signature Bank had become the second largest provider of banking services to the cryptocurrency industry, second only to Silvergate Bank, close quotes. As a side note, a buyer for Silicon Valley Bank, the failing bank, wasn't found, although HSBC Holdings bought Silicon Valley Bank UK branch for a grand total of £1. It's interesting that they didn't offer it out to the general public. If they had done, I might have put a bid in. Selling a single table in the building would have covered my outlay. Moving on. To get a better understanding of what went on, let's pan out a little and look at common banking practice. Many banks invest their reserves in long-term US Treasury bonds because historically they've been regarded as being safe. But low risk usually equates to low yield. For those of you who don't know, the financial return on an investment expected by an investor is commonly referred to as yield. One thing to bear in mind is that the value of bonds is linked to interest rates, so their value in the marketplace is dependent on whether interest rates are high or low. When the Fed funds rate is low, the yield on a bond is low. How bond prices are determined is a hugely complex topic and beyond the remit of this video. All we really need to know is that there's an inverse relationship between yields and prices. Picture the situation like a seesaw. So when the yields go up, the prices for bonds go down, and vice versa. When the yields are low, bond prices are high. Anyway, interest rates have been low for a good number of years, so bonds were offering low yields. Low yields mean high prices. The problem is that in 2020, the Fed began to aggressively raise rates. The yields started to go up, the prices for bonds went down. Therefore, the market value of the bonds held by banks in their reserves became lower. The value of their capital reserves declined. These are known as unrealized losses. This needn't be a problem, provided that the bondholder holds the bonds to term, because when the bond reaches its maturity date, the government pays out the amount owed. No big deal. But what if the bank needs to raise cash all of a sudden, for whatever reason? To raise funds, they have to sell these assets. But why would any investor want to buy these old, lower yielding bonds when new bonds with higher yields are on offer in the marketplace? The short answer is that they wouldn't. The result is that to find a buyer, the bank is forced to sell the old, lower yielding bonds at a significant discount. This is basically what happened when depositors started to withdraw their money. Banks needed funds to cover the costs of the withdrawals, and they had to sell their bonds at a loss. Losses were huge, and they got into serious trouble. Silicon Valley Bank, for one, appears to have been a classic bank run. When it was announced that it was trying to raise funds, depositors started to take their money out. Let's switch focus now and turn our attentions to First Republic Bank based in San Francisco, California. The profile of First Republic Bank is similar to Silicon Valley Bank. It also found itself to be in serious trouble in March and was on the verge of collapse. It emerged that it had a loan-to-deposit ratio of 111%, meaning that it was loaning out more money than it had in deposits from customers. Such practices, to my mind, should be illegal. But anyway, there were rumours that JP Morgan were going to buy it out. On the 16th of March, in order to forestall a bank run, it got a $30 billion bailout, the funds coming from 11 of the nation's largest financial institutions, including JP Morgan, Wells Fargo, Morgan Stanley, Goldman Sachs, the usual suspects. This cash injection was only to cover withdrawals, and they could only have this facility for 120 days. They got a separate $70 billion loan facility from JP Morgan. They also borrowed $109 billion from the Fed. All deals agreed put the total bailout to $229 billion. Even now, they've only got a liquidity cash position of $34 billion while having a $175 billion deposits on their books. So if more customers want to withdraw their money, they're going to find themselves in serious trouble once more. Switching focus once again, the American authorities were relatively quick to respond to these events. The Fed and the US Department of Treasury issued a joint communique stating that extraordinary measures would be taken to guarantee deposits, not just up to $250,000 in accord with FDIC regulations, but all depositors' money. This is obviously good news for depositors. The Fed also set up the Bank Term Funding Program, which offers loans of up to a year to banks. They would provide banks that were in trouble with treasury bonds and mortgage-backed securities as collateral. So they're implementing emergency measures. QED, we can reason that it's an emergency. All that I've outlined above is what has been publicly stated. I dare say much is going on behind the scenes that we should know about and we should be concerned about. I'm sure that other banks are getting cash injections from the Fed in secret. Anyway, essentially, the government and or the Fed have stepped in to shore things up. They're backstopping things. But is this enough to prevent any further bank runs? No. Some people are continuing to get their money out of banks, believing them to be at risk. There's a self-fulfilling prophecy aspect to this behaviour because it puts banks in some jeopardy. But whatever, people are getting jittery and for good reason, so I don't blame them. As I've said in other videos, for a number of years my preference has been not to have any money in any banks, or at least the bare minimum to cover monthly expenses. Moving on. Some people are transferring funds to bigger banks like JP Morgan, Wells Fargo, etc. So supposedly too big to fail banks. This is understandable, but not a very wise move in my opinion. I've done my best to exit their system altogether as much as possible, so I'm not affected by their shenanigans, but that's just me. You're free to do as you wish. This is not financial advice. We will see, will we see any more bank failures? For sure. The problems that brought down these three banks are not limited to these banks, as we saw with First Republic Bank. The likelihood is that we're going to see more bank failures for the reasons that I gave above about what happened to interest rates and other reasons besides the general economic environment we're in, etc. Anything the authorities say is an effort to prevent contagion and stabilise the situation for the time being at any rate. And that is understandable, but I'll talk more about this in a later video. I split the topic into a number of videos, so there's another maybe 2 or 3 to follow. In the next video I'll talk about Credit Suisse and UBS, the debacle that went on in Switzerland. In the third video I'll make some general comments giving my thoughts on what I think is occurring. Wise up and rise up.